Today I want to talk about making decisions where taxes are an important component of the decision by looking at the various components of a tax calculation. Now, of course, economic decisions or projects can have very complicated cash flows involved with them. But by and large, they tend to have a fairly standard structure of first cost, savings, and salvage value. So if you're buying a piece of production equipment or something like that, it have this kind of a structure. And the components of a tax calculation I'm going to be reviewing today really applies to this structure. And you'd have to do something different if you had a different, a more complicated cash flow structure. But each of these components can be dealt with in a different way. First cost. We know from previous work that the capital cost tax factor allows you to determine the present worth of an asset, taking into account the future benefits of depreciation. So for the first cost, when you're considering all the components of taxes, has to be reduced by that capital cost tax factor. Savings are a little bit different. Savings are reflected as income to the company because they're adding money to the company. And that income is taxed. It's taxed at a tax rate T. So future savings from a purchase are going to be taxed, and the benefits are in fact reduced from what they might appear. And they'll be reduced by that tax rate. So the remaining savings will be 1 minus the tax rate. For salvage value, you may recall that when we looked at the changes to the undepreciated capital cost. If something is salvaged, that undepreciated capital cost is reduced in value immediately in the period in which the salvage takes place, rather than being split over 2 years as the first cost is. So the new CCTF applies to the first cost because its asset value is split over 2 years. But for salvage value, it's the old CCTF that's affected. We have to use the CCTF because as soon as we salvage something, we can no longer depreciate it, and all the future cash flows associated with that depreciation is lost in the salvaging. So even though we get a certain amount of money for salvaging the asset, the real value is reduced because we don't have that future depreciation. So in doing a tax calculation, you have to treat each of these components separately and in the correct way. Let's do an example of this. What's the after-tax present worth of a new widget crimper if it costs $12,000, saves $4,000 per year over its 5-year life, and interest is at 8%? Assume a $2,000 salvage value. Now first, it's after tax, we're given a tax rate. Corporations have tax rates that vary according to its size and location and so forth. But a rule of thumb for corporate taxes is 50%. So if a tax rate is not given in a question, 50% would be a good assumption for it. But we are in fact given 50% in this case. Now we're going to be looking at the 3 components of our tax calculation: the present worth, savings, and salvage value separately. And I'll call them P1, P2, and P3. So P1 would be the first cost. It's going to be $12,000 times the new CCTF. So we have to calculate the new CCTF. If we were in a company, that new CCTF may already have been calculated. We'd just have to look it up, or it would be given to us. But in this case, we calculate it. In this case, it's equal to 1 minus T, the tax rate, which is 50%, times the depreciation rate. We aren't given a depreciation rate. However, this is a widget crimper, where it sounds like a piece of plant for equipment. And so we're going to assume 0.2. And that's a normal assumption for production type problems for a depreciation rate. Times 1 plus 1/2, or 0.5, times the interest rate of 0.08, divided by the interest rate, 0.08, plus the depreciation rate of 0.2, times 1 plus the interest rate. Now that calculation is straight from the formula for the new CCTF, and that works out to be 0.6561, so that P1 is equal to 12,000 times 0.6561 is equal to $7,873. Now I make a slight change here just to keep track of which of my components are costs and receipts. I'm going to put a minus sign in front of the 12,000 because it's an expense, it's money going out. So our P1 component of the tax calculation is minus $7,873. The present worth of the crimper is actually less than its apparent cost. Now for savings, I'll call those P2. We've got our $4,000 per year in savings. Now, we want this to be present worth, so we have to take that back to the present using our series present worth factor at 8% over the life of the asset of 5 years. However, we have to take the tax effects of into the savings. Because these savings are going to be income, which will be taxed, we have to recognize a reduction in the actual value of those savings by 1 minus t. That's equal to 4,000 times 3.9926 as the series present worth amount, and 0.5, 1 minus t, t is 0.5, so 1 minus t is 0.5, and that works out to be $7,985. Now this is positive this time because this is income as opposed to an expense. Our third component, which I call P3, is the salvage value. Now recall that the issue with the salvage value is that the UCC is reduced by the full salvage value in the year the salvage is taken, as opposed to being split between the 2 years. So we need the old CCTF here. We have a salvage value of positive $2,000 because there's money coming in. But this one is times the old CCTF. So we have to recalculate the CCTF using the old formula. Now, at least this is a little bit easier. It's 1 minus the tax rate T of 0.5 times the depreciation charge of 0.2 divided by the interest rate of 0.08 plus the depreciation charge of 0.2. And that works out to be 0.6429. So the total present worth for the salvage value then, P3, is going to be the $2,000 apparent salvage value times that old CCTF of 0.0429. And that works out to be $875. Now, to calculate the present worth of the asset in total, taking into account both the first cost, the savings, and the salvage value, we simply add those components together. So the total present worth is P1, which is the first cost, modified by tax effects, plus P2, which is the savings modified by tax effects, plus P3, the salvage value, modified by tax effects. And that actually works out to be $987. So the idea here behind these tax calculations is that we have to take the taxes into account. The taxes that are affected by depreciation, by taxes on income, and also recognizing that the depreciation effects are different for a first cost as for salvage value. But if you understand the components to the calculation, understand what the CCTF means, what the CCA is, how the UCC works to explain why you use the old CCTF with first cost and the new CCTF with the first cost and the old CCTF with salvage value and so forth. Once you understand that, the actual calculations are fairly straightforward. And you can do this present worth calculation now being much better reflective of the true situation because it does take into account those taxes. Thank you.